Good evening, esteemed participants and panel members. A warm welcome to today's session on Budget 2024, hosted by DirectX Committee of ICAI. We are honored to have with us two experts in the field of taxation who will provide invaluable insights during our discussion. First, I would like to introduce CA Piyush Chachad, the chairman of DirectX Committee. CA Chachad is a senior partner at Chachad and Doshi Chartered Accountants with an impressive career span of over 24 years. His expertise in both direct and indirect tax litigation is well regarded, and he is particularly skilled in appellate and arbitration proceedings. In addition to his practice, he plays a pivotal role as a member of working committee of Asian Federation and Accountants and contributes to the Reserve Bank of India's Asset Reconstruction Committee. His contributions to the WIRC publication on Vivad se Vishwas scheme are widely recognized, and his presence today promises to add great value to our discussions. We are also privileged to have with us CA Gautam Nayak, a chartered accountant since 1986 and a partner at CNK and Associates Chartered Accountants. CA Nayak has held the position of co-chairman of Direct Taxation Committee of the IMC Chamber of Commerce and Industry, serving from 2013 to 2020 and resuming the role from July 2024. He is also a long-standing member of Finance and Investment Committee at IMC. As an accomplished author, he has co-authored 4 editions of subjects like transaction in shares and securities, taxation and accounting, and taxation of charitable trust. His contributions to the BCAS journal and his appearances on various forums and news channels as a tax expert are a testament to his deep knowledge and commitment to the profession. We are truly delighted to have both of you with us today. Without further ado, I would like to invite CA Piyush Chachad to deliver the opening remarks and commence our panel discussion.
Thank you very much, Grishma. A very good evening to all the participants. Welcome you once again on this Thursday webinars, which Direct Tax Committee is hosting since month of February. And I also welcome and thank CA Gautam Nayak, a senior partner, a tax expert, senior partner of CNK and Associates, a well-known firm from Mumbai. Thank you very much for joining us and agreeing to deep dive into our budget provisions, which is very much needed. Friends, as you are aware, this is a continuous program which Direct Tax Committee is doing on every Thursday webinars. We didn't did last week, obviously, as you know, we were in midst of the budget at that moment of time, and we were doing already an online programs were been done. On 23rd, when the budget came in the evening itself, we had done a program on the first cut, wherein CA Girish Ahuja from Delhi addressed the audience. And there was also deliveries done by our president, vice president, and chairman and vice chairman of Direct Tax and Indirect Tax Committee. That was the first cut. Hereafter, on 24th, we had a program again that was little deep dive by Girish Ahuja. It was a physical program in Delhi, and it was live telecasted. This time on 26, we also did one program in Mumbai along with the WIRC, which is done every year, where Gautam Doshi does an analysis of the budget, which was done. And we thought after that, because anyways, every Thursday we do a program, it was after so much discussion happening on the social media, after so much discussion happening through the videos, through the budget booklets nowadays, because we get a budget booklet. It was not 15 years, 20 years back, but I see budget booklets been sent by most of the chartered accountants, practicing firms, law firms, and they give their analysis, they give their background. So still there is a need to go into intricacies of those particular sections, those particular deep dives. And let us take an example. The idea behind this today's seminar, I'm sure with Speaker Gautam Bhai also will try to do that. I will also try to do on 2 or 3 aspects. Basically dealing with the procedural aspects. His idea is to go a little further in. We all know what changes have happened now broadly, but how will it actually impact? What would be the role of the department based on those amendments? What action they will be required to take? How would the assessees or the practicing members would have to relook into it? Whatever they have actually been doing it, that's more important, which we need to understand, especially when it comes to chartered accountants. Yes, who are the practicing members, people look forward to you. People are looking forward to you for an advice that how they should actually look into it, how they should apply the provisions of this budget, which may impact this financial year and years to become. So it's very important to understand these provisions. I know in detail, Gautam Bhai would be going into various other provisions. I'll just touch upon 2 or 3 important things. Before I go into the important budget provisions, I would just like to clarify on this, because a lot of representation members are writing to us that are we representing on certain amendments which have been proposed in the budget. I know indexation issue is there as far as long-term capital gains is concerned. Dividend, but considering buyback as a dividend, taxing it at higher rate, capital loss, whether how it would be allowed, obviously in detail, Gautam Bhai would be deliberating it, but whether we are making some representation on that. Just to inform all the members, yes, draft of post-budget memorandum has already been prepared by Direct Tax Committee. It has been today afternoon itself, I have approved it. It has gone for the approval of the President. And it would be most probably submitted by tomorrow. That's our idea is. We are running short of time. I know because this time the budget came late. It has to be passed in this session itself. I've been told this session will get over on 12th of August. And before that, obviously, Lok Sabha has to pass. Thereafter, it has to go to Rajya Sabha. So even the government is running on time, they are on their foot to get it passed. Otherwise, it will take another month or two before the session comes in, maybe winter session directly. So obviously, it will be passed in this session itself. So it's very important that this post-budget memorandum goes. But just for your information, because on 24th of the meeting, this time we had called CBDT chairman and Joint Secretary of Tax Policy Legislation 1 and TPL 2, what we call, Mr. Raman Chopra, Mr. Jindal, both were there. And unofficially, when we had after this budget discussion, we had a meeting with CBDT chairman. And we said that because within 24 hours, because the already first cut was out, and we all knew that people are worried about 3 or 4 important amendments. So we thought we'll informally discuss with them that is there any changes expected. Of course, we'll give a post-budget. It's our duty to give our post-budget to set right which is going wrong. Whether accepted or not, it's all their choices, obviously. But considering our pre-budget memorandum, wherein a lot of our suggestions were accepted, we thought let us give post-budget memorandum. But informally, we discussed with them. And of course, they did not respond that well, which I presume that I do not expect much changes because there won't be any much time for deliberation also. There's no physical meeting this time possible before the Lok Sabha passes. And therefore, I have a very limited hope to the extent our representations which will be made by various bodies would be accepted or not. I should be very fair and I should be forthcoming on this as a chairman of Direct Tax Committee. So I am coming on that. I would not keep, I would like to state what has happened and what has transpired between the discussions. As I know, even if you see the issues which have come in the tax filings, all this was discussed, open issues were raised during those meetings with the CBDT chairman, but obviously they always compare how many number of returns have been filed. That's what their idea is. So keeping that in mind, of course, our post budgets will go. I'll try to, once it is submitted, I will also try to upload it on our website of DTC page of ICA. Please do look into it. Of course, we had invited suggestions, but I know the July rush, you would have not been able to respond or give your suggestions because everybody is fighting with their own practice, your own clients, which is obviously very important today. So before I go, I would like to just touch upon 2 or 3 important amendments which I had discussed earlier with Gautam Bhai, that I'll try to take up those as a part of which has been introduced as a process of rationalization and simplifications. I could see of 3 important amendments which I will touch upon, and thereafter Gautam Bhai will take up from there, which are the substantive amendments. First amendment is in regard to section 148, 148A, and 149, 150, 151, which deals with the reopening of assessment. Now, this reopening of assessment has been talked about long. We all know it has changed recently in 1st April 2021, wherein the time period for the reopening was increased from 4 years to 6 years, which was there under the earlier provisions, was increased, I would say, to 10 years in a specific situations where the income escapement involvement or the amount involved in of income escapement was more than 50 lakhs. So it was increased up to 10 years in 1st April 2021 itself. And a new procedure was introduced, which was an outcome of various judicial judgments, including GK and drive shares. A procedure was introduced under section 148 capital A, that these are the safeguards so that the reopening should not be resorted very lightly. It should be only done in these specific important cases where there is an escapement of income. I mean, the lines were changed. So reasonable belief was changed with the suggestion to a suggestion, the amounts or the evidence or the information which suggests that there is an income tax escape assessment. So this was changed. What they have done is this year, the most significant, there's not major change, but the section 148 to 151 have been completely changed. Though there is an impact, if you actually read, it is nothing, there's no change, only like in 148A, there were subclauses A, B, C, D, which have been replaced by subclause now, subsection, I would say, 1, 2, and 3, but the procedure more or less remains same, except there was an precedent require an important that assessing officer before issuing a show cause notice for reopening under 148A subclause B, he was supposed to do an inquiry with the prior approval. Now, there's no need of doing an inquiry. If he has an information in regard to escapement, he can directly issue a show cause notice. And after issuance of show cause notice, he should give a prescribed time limit. So there was an earlier time limit, a minimum time limit of 7 days, but not exceeding 30 days should be given to the assessee for responding to that show cause notice. That has been removed. And it says whatever is the time limit that has been prescribed should be given. So there is no major changes. Thereafter, he has to pass a speaking order now under the new provision under the subclause 3. So 148 subclause 3, you have to pass an order, speaking order. And once this process under 148 capital A is over, then he can revert to section 148. That's the changes which has happened majorly. Plus, as far as approval is concerned, the prescribed authority was given in section 151, was the commissioner or the principal commissioner. Now it has come down, the ranking has come down to additional and joint commissioner. So with the approval of additional or a joint commissioner rank, obviously he can resort to issuance of show cause notice also and issuance of final notice under section 140. Most significant change, which I said was in respect of period, which has now been reduced from 10 years to 5 years. Obviously, if somebody has read the newspaper, and we were also doing analysis, let us take an example of assessment year 1516 to 1890. That is my March 15 financial year or a March 18. They could have been reopened in a specific situation where income escapement assessment was more than 50 lakhs up to 10 years. Presuming they were not getting time barred under the revised provisions of section 148, which was introduced up to 1st April 21. That is also a disputed technically. Up to 15, 16, 16, 17, 17, 18, whether they were getting time barred or not. There is a controversy. Bombay High Court has already come with some ruling. Keeping that in mind, what that department view was that 15, 16, I could have opened up to 10 years. But that is the last date for opening 15, 16 would have been March 26. Similarly, 16, 17 would have been March 27. Now, because the period has been reduced, and this provisions, the new provisions would come into effect from 1st September 2024. So any notice issued after 1st September 2024 would be subject to the new provisions. So let us take a time limit of this 3 years and the 5 years, which has been prescribed under section 149, would be effective from 1st September 2024. So in case a notice has to be issued after 1st September 2024, they cannot be issued for assessment year 15, 16, 16, 17, 17, 18, and 18, 19, because it would be beyond the period of the 5 years. So in case the department has that information, and because they were under an impression that it would take a time of 10 years, they would get time barred after 10 years, up to 10 years, they have not issued the notice. So I believe in this particular month, August, they may have to come out with spate of notices. They will have to work faster. They will have to first issue a 148A show cause notice, give a time period to respond to you, and then obviously you will. So I would not be surprised if there is certain information available, but the considering the time available for the assessment and considering the ongoing matters, the assessing officer had not issued a show cause notice because they were not getting time back. But now they will have to issue a notice within the 30 days period and complete the complete procedure given under section 148 capital B. According to me, it's a welcome move because we're reducing the time. You're going back. It's like an old wine in new bottle. Because the time limit, which was increased from 6 years, outer time limit from 6 years to 10 years, it has again come back to 5 years. So in effect, even from 6 years, it has come down to 5 years, and only in a specific situations. A regular situation, 3 years time limit continues. They've given additional 2 time limits now for issuance of notice under 148 capital A, which is a show cause notice, and thereafter, because there is an show cause notice issued, a response is taken from assessee, and thereafter speaking order has to be passed. They have given a time limit of 3 years. A 148A notice should be issued within 3 years. After following the procedure, additional 3 months time has been given. So because this procedure may take time, considering that situation, the 148 notice ultimately can be issued within 3 years, 3 months, or 5 years, 3 months. So that's one of the significant changes which have happened. So there are otherwise more or less the provisions in regard to what do we mean by information remain same. Another significant change is in regard to removing the search out of this. So that takes me to the second amendment. Now, this amendment has been made whereby the search assessment, any search which takes place after 1st September 2024, which were to be assessed under the provisions of Section 148, 148A after 1st April 2021 has been removed from this. So now the reopening will not be resorted in case of search. Survey will continue under this. Any information received under 135A scheme framed by the CBDT under 135A would be continued under the reopening provisions, but search is no. What happens to search? That takes me to the second amendment, which is again old wine and new water. I remember a block assessment happening when I was actually qualified. And block assessment continued up till June 2003. After that, it was replaced with 153A and 153C, wherein separate assessments were made for individual years. Those separate assessments were for 6 years. Up to June 2003, there was a block assessment for a search period comprising of 10 years, basically. But after that, it was reduced to 6 years. Individual year-wise assessments were happening. Most prominently, let's take an example. If there was a search happening after June 2003 and before 1st April 21, when the search assessment was clubbed into 148 and 148, the assessing officer was obliged to issue a notice for the previous 6 assessment years preceding the year of the search. So he was supposed to make a separate assessments for all the 6 years. Tax was leviable at the rate of whatever applicable tax rate. Interest was recalculated. A lot of controversies were there. What is an undisclosed income? How, whether the addition, how the assessment would abate, how it would be unabated assessment. In case of abated assessment, whether I can make an additions which are also in regard to appearing in the books of accounts, or I should limit my additions to incriminating material. So a lot of controversies happen. Judgments of Delhi High Court, including Kabul Chawla, Bombay High Court, a lot of came in. So I'm not going into that. But before 2003, there was a block assessment. So only a single assessment used to happen. They have gone back to that, obviously, with certain changes which have come. So they have reintroduced a chapter 17B, which deals with the block spatial procedure for assessment in search cases. So once the search happened, after a particular date, that is when it is coming to the statute, is 1st September 2024. The assessee is obliged to make an assessing officer is obliged to make an assessment for a block period. What does a block period means? Block period means it's the 6 assessment years preceding the previous year in which the search was initiated. So if the search is happening on 1st September 2024, block period will pertain to financial year up to March 24, because September 24 up to March 24, starting from 1st April 2018. For this particular 6 years, he has to make a single assessment, which will be called as block assessment. What will happen to other assessment proceedings which are ongoing? All will abate. Under the new provisions, he will have to actually assess total income. And total income has been defined. Total income includes undisclosed income, which has been again defined under this new provisions. This total income will also include income which is assessed under 143.3 or maybe 143.1, or total income which has been already returned by you. So what the assessing officer has to do is he has to assess the total income, which includes undisclosed income, that is income unearthed during the course of search, number 1. Income which I have filed in a return pursuant to search which has happened for a block period. 2. Third, income which I had filed in the regular returns filed under section 139(1). Or if income which was assessed under 143.3, where I had filed a return and income was assessed at a higher level. So I will have to take that particular income. Obviously, I will not re-include those income which I have already included in my return under section 139. So he has to arrive at the total income. And then total income has to be assessed while applying the tax rate, because it's a higher tax rate which has been prescribed for this. You have to reduce the out of those total incomes, the income which already I had disclosed it in my return, or already an assessment was being made to that extent. I'll reduce that, and on the balance total income, not undisclosed income, balance total income, I'll pay 60% tax. Now, this 60% tax has to be paid on total income. As per the department's understanding, they would be feeling that he's paying only on undisclosed income. Because again, I'm getting, first I'm including all this income which I've already declared in my 139(1) or which have been assessed under 143. But while calculating tax, I'm again reducing it and reapplying the tax rate of 60% only on the balance. Now, the question over here arises, what do you mean by undisclosed income? Because in effect, you remain back to undisclosed income. Undisclosed income has been defined under 158B, which has include now, apart from others, if any bullion, money, jewelry, other valuable article, thing, expenditure based on any entry in the books of accounts, which is now also covered. The most important entry which I could thought of is any expense, deduction, or allowance claimed under this act, which is found to be incorrect in respect of the law. So let us take an example. I've already filed a return of income that has been assessed under section 143(3) already. No addition would have been made at that moment of time, for an example. Now the block assessment happens, and during the block assessment search, core material or maybe not core material, that would be a disputed issue now. If any assessing officer comes to a conclusion that the expenditure which has been claimed, for an example, traveling expenses has been debited to P&L, is not correct, is incorrect, it is not for the purpose of the business, and he disallows us, that will be treated as undisclosed income. So any expenditure claimed in the books of accounts or any deduction or allowance which in opinion of the assessing officer is not correct may be fall under the undisclosed income and subject to higher tax rate of 60%. I believe that is too harsh, because the idea behind undisclosed income is that it should be backed with the incriminating material found during the course of search. Addition should be limited to be during the course of search. So they have included in this additions which will be made out of the books of accounts in the definition of the undisclosed income, number one. And at the other place where the tax rate has to be applied under section 113, they've removed the word undisclosed and they said the tax rate would be applicable in total income. What would be total income? Obviously, after reducing the income which has been already offered to tax under 139(1) or assessed under 143, what remains balance is total income, which will be subject to 60% tax. So, looking forward to a spate of litigations happening on this particular ground. We are trying to make a representation on this, that the definition of undisclosed income is too wide. That is not an idea behind the search assessments. You cannot actually include therein any expenditure which have been already recorded in the books of account. They may have been assessed already under 143(3), but because now the addition has been made post search, considering that as forming part of a block period, you want to tax it at a higher rate, it doesn't seem to be going well with the idea of the search assessment. Obviously, otherwise, the block period assessment definitely will bring down the litigations, number of appeals, number of penalty appeals, which otherwise would have been 6 appeals, then the 6 appeals for quantum, 6 appeals for the penalty. This will go down. Apart from 60% tax rate on this total income, which is after calculating various permutations and combinations, which itself requires a lot of deliberations, what will impact, how the calculation will happen itself, I'm worried, and I'm sure a lot of order giving effects, mistakes will happen in this. So a lot of work on this. But apart from this, there is also a penalty prescribed at 30%, I would say, of total tax payable. So it is in effect 50% of the total tax payable. So in very short, it comes to 30% because you are paying 60% of the total income. And the penalty is 50% of 60%, which in effect comes 30%. So that penalty is also payable unless whatever income, that undisclosed income you would say, or you would say total income, has already been disclosed in the return filed pursuant to the search, then no penalty is imposable. There's no interest imposable as of today. There's no surcharge imposable as of today. So it limits to 60%. So this is the basic provision which has come in regard to search provisions. And very importantly, which I could notice, one of the important is that for a particular block period, let's take an example. Because now you're assessing for the 6 block periods and you are including total income which is returned under section 139(1) to assessing total. Let us take an example. For the 6 years, I had a loss in. So I'll not include that amount in my total income, my sum. Now this loss, once you are determining a total income for all these 6 assessment years together, If there is a loss in a particular period, why that could not have been adjusted? There is a restriction which have been put. And they say if there is a loss which is returned in any 139(1) or 143 assess, that loss will be carried forward under the regular provision. So this loss could not have been adjusted. Otherwise, what would have happened under 153A is, because every year was assessed separately, if I had returned a loss under 139(1) and there is some addition coming up by the assessing officer, that loss would have been adjusted in the normal course, which now this would not be available, which seems to be little difficult according to me. And that's what it is broadly I thought I'll cover. Third, importantly, which was again an important suggestion made by the institute in regard to the considering the pendency of the appeals. Wherever we go under a direct tax committee, we have been told by the people that there are a lot of appeals which are pending since more than 10 years, 12 years, and it has not been disposed at CID appeal. So we have made a representation that you should come out with certain schemes, if at all. If somebody wants to avail, he may avail or he may continue it. But there are a lot of small matters which are pending for 8 years, 10 years. If they could come out with some schemes, is similar to VSV 2020. And they have come with the scheme VSV 2024. I believe it's a good move. At least it will help in reducing. I don't know how far it will have, but it will help in certain reducing certain appellate proceedings, which are small matters. Now, this same scheme is more or less similar to the scheme of 2020. I've been told, I was reading a one particular press release that during VSV 2020 also, a disputed tax amount of around 99,750 crores was settled. Of course, they would have recovered amounts less, but the amount of settlement, because there would be interest and penalty, which was completely waived during that period also, and which is proposed to be waived in this particular scheme also. So what does this scheme say? That if any proceedings are pending before any appellate authority, and file an appeal before any appellate authority, those could be settled. You pay 100% of disputed tax. You do not pay any interest and penalty. You only pay tax dues, which was determined under the assessment order, 100%. If that appeal has been filed after 31st January 2020, that is when the VSV 2020 ended. If that appeal was filed earlier to 31st January 2020, and you had not availed the scheme, but now you want to avail, you pay 110% of tax dues. I think so that's fair enough, because the people would have already availed, as it says, 99,750 crores of tax settlement was happened under VSV. So obviously it cannot be kept, those people cannot be at the par with the assessees who have filed appeals after 31st Jan 2020. So they have to pay 10% addition. So if I'm paying 30% tax along with plus surcharge plus education cess, I may have to pay 33% because it is 110%. Plus, if I'm filing a declaration up to 31st December 2024, then the rate of 100% is available. Otherwise, if I pay any tax after 1st January 2025, up to the last date, which has not been prescribed today, I have to pay additional 10%. So if I'm paying 100, I have to pay 110%. If I'm paying 110%, because my appeal was filed before 31st Jan 2020, I have to pay 120%. If my appeal only pertains to interest and penalty, then I have to pay 25% of the disputed interest or penalty or fees. Similarly, I have to pay 30% after 1st January 2025. And similarly, if this appeal pertains to period before 1st January 2020, then I have to pay 30% of disputed interest, penalty or fee, or 35%. So there's a difference of 5% which increases. I believe this is a good scheme which will be taken over. It's only 4 years, January 2020, and now we are almost in July 24. Within 4 years, government has come with this scheme. But obviously, considering the pendency which is involved, a lot of appeals filed prior to 31st January 2020 are still pending today. I'm sure assessors would like to avail that. In 4 years, at that time, they could not avail, whatever may be the reason. But in the 4 years, obviously, your interest risk also goes up. Another 40%, you're paying 12% simple interest, 30-40% your demand may go up. And you would be paying only additional 10% to that extent. So it may attract certain, but there are a lot of clarifications and FAQs are expected in this. Likewise, it came during VSV schemes also, that how it would be covered, what are the areas, whether only on one particular ground I can take VSV, because there are a lot of judgments which have come after VSV 2020. And I'm sure based on those judgments, keeping that in mind, they will issue a clarification. Like for an example, if I have a 5 grounds of appeal and I have to opt for 1 ground of appeal under VSV, whether I can do it. They didn't permit it under the VSV 2020, but the matter went before the courts, and courts have allowed in such cases. So I'm sure this time they will clarify beforehand such issues also. even in case where the miscellaneous application is pending, but no appeal is pending before the tribunal, whether I would be eligible or not. So all these things, I'm sure, how would the adjustment of disputed tax, which I paid during VSV 2020, but I could not avail that particular scheme because I could only pay part payments. I could not pay full payments, whether those can be adjusted. So we are expecting a lot of clarifications and FAQs on this. So with this limited 2 or 3 important points, I thought I'll try to address on this. Thank you very much, being here. Of course, I'm here again. And now I will hand over the charge to Gautam Bhai, who will take us through the substantial tax provisions. And I will be there again. And at 7:30, we'll take up questions and answer sessions when Garishma is there. And we'll try to answer along with Gautam Bhai. Thank you very much. Thank you, all the participants. Over to you, Gautam Bhai.
Thank you, Piyush. Uh, so, uh, I think you covered these amendments so far as the these three important provisions, I think, in a very short time. And what I would try to do is in the next 1 hour, there are very many amendments which we need to look at, but I will try and focus on the some of the larger ones, some of the most important ones. And the others we will quickly run through maybe. So coming to the point about rates of tax, under old tax regime, as you see, no change. Under the new regime, that's the default tax regime, and you just have two changes in slabs. From 6 lakh, it goes up to 7 lakhs, and the 9 lakh goes up to 10 lakhs. So therefore, there's a small, your rebate under 87A continues to be the same. Foreign companies tax rate goes down from 40 to 35%. The logic for this is that domestic companies tax rates have come down, and therefore this should be there. To discourage futures and options, the STT rates have been increased from 0.0625 for options to 0.1%, and for futures, it's been increased. But I don't know how much of a deterrent this will be to individuals, because the STT is comparatively a small cost. Maybe other measures which SEBI will take will really help in bringing down the speculation. But when the new regime, we saw that there's only a 1 lakh increase in the slab rates, but besides that, there are 3 amendments which are only for those who are opting for the new regime. And one is that the increase in standard deduction from 50 to 75,000, family pension from 15 to 25,000, and the deduction under 80CCD2 for the non-government employers' contribution to NPS, National Pension Scheme. Earlier, this was what happens is that the contribution to National Pension Scheme by the employer is first treated as an income, and thereafter you get a deduction under 80CCD2. So that was limited to 10% earlier. Now, for non-government employers, that has been increased to 14% of salary. And this will be in addition to the employee contribution, where employee can claim a 10% of salary under 80CCD1 for contribution to NPS, plus another 50,000 under subsection 1B of 80CCD. So this is in addition to that. Now, one of the things, and which is people often ask is, this old regime and new regime, how long is it going to continue? And 1 year, the CBDT chairman and having said that around 60% of the returns or 65% have opted for the new regime so far during the last year as well as current year. And I think they're trying to increase the gap between the old regime and the new regime to make the new regime more attractive over a period of time. So that whereby people will then finally opt for the new regime. And possibly a time will come when maybe if 90% plus opt for the new regime, then the government will probably phase out the old regime completely. That seems to be the thinking right now. And, instead of forcing people to opt for the new regime. Coming to charitable trusts, I think for this year, this is the first year after a long time that we're seeing some provisions of some amendments which are not hostile to charitable trusts. In a sense, some of them are really also needed. It's helpful. The first thing is, you have today 2 tax exemption regimes for charitable trusts. One is under 1023C and the second is under section 11 and 12. Now, 1023C, as you know, is a very complex. You have various clauses. You have 3AB, 3AC, 3AD, and 3AE, which apply to medical and educational institutions, which are where the gross receipts are less than 5 crores, or which are wholly or substantially financed by the government. There, you don't have any provisions, any conditions attached to it. But when it comes to clauses 4, 5, 6, and 6A, There, when you look at it, which is again medical institutions, educational institutions, institutions of public renown, religious institutions of all India renown. Now, in these cases, there are as many as 22 or 23 provisos. Keeping a track of that is extremely complex. It's one of the, I would say, the most complex provision of the Income Tax Act. And, a couple of years back, what they did is that they brought the provisions almost at par, except for two or three small differences. 1023C and Section 11, the almost similar provisions existed for the last 2 years. And finally, I think they've realized that now the process of merging both the two exemptions and giving only one set of exemption, they started the process whereby the process is that if you have an approval under clause 4, 5, 6 or 6A under 1023C, here also you need approval just like under section 12AB you need for claiming exemption under 11 and 12. You can continue to claim exemption under these clauses until such time as that approval is valid. If you have to make an application for renewal of that exemption on or after 30th September, then that application has to be made only under section 12AB, that is under section 12A, read with section 12AB. And so therefore, thereafter, you will be entitled to exemption under sections 11 and 12. And so that is the position. So you have to make the application again, the same time limits are applied 6 months before your expiry of your approval. And in case of provisional approval, 6 months before expiry of your approval or within 6 months of commencement of activities. And it's the same manner as your application for renewal of registration or a provisional registration under section 12AB. Now, currently, there is no change for the exemptions for clauses 3AB, 3AC, 3AD, and 3AE. That is the smaller trusts which gross receipts of less than 5 crore. And those which are wholly or substantially financed by the government. For them, there is no change. They continue to get full exemption without any conditions. So that will continue. And possibly, once the final migration happens, at that point of time, these clauses will come under section 11. They will have a special exemption for these small trusts or those which are financed by the government. So far as the investment pattern is concerned, you have certain investments permitted under section 1023C, which are not there under section 11.5. Under 11.5, there are certain permitted investments. So therefore, you have now this permitted investments will continue even under section 11.5 for 1023C trusts which are migrated. And those are assets forming part of corpus as of 1st June 73, which is there under 11.5 for this. Then equity shares of a public company forming part of corpus as of 1st June 1998. And debentures acquired before 1st March 1983. So these conditions, these similar exemption, if this was held by a 1023C trust prior to opting for going in under section 11, that benefit will continue under section 11. They can still hold. Then there is one more amendment, and and for charitable trusts, and that is in relation to section 11.7. 11.7, as you know, gives you an option either to claim exemption under 1023C or under section 11. If you are registered under 12AB, they're saying that you will not be eligible to claim exemption except under section 10.1, which is for agricultural income, or 1023C, or there were two clauses added last year. Now to that, two more clauses have been added, 1023EA and 1023ED, and one more is 1046B. So 1046A was added last year. So that also you can claim even if you are registered under 12AB. So you can still opt for to claim under that. So that is the condition there. The one very important and beneficial provision, which is, today when you have to make an application for renewal of your registration, and particularly the trusts which are provisionally registered, because the ones who got your 5-year renewal, they were already registered earlier, you got your 5-year renewal up to March 26. So therefore, you will have to apply for renewal in September 25. So there is, so far there has not been a problem. But those who got approval for a period of 3 years, the provisional registration, once it was a provisional registration, you're supposed to apply either 6 months before expiry of that 3 years or within 6 months of commencement of activities, whichever is earlier. Now, very often they miss that point about 6 months of commencement of activities, and therefore they miss the bus and the applications were rejected. Now, rejection has a very severe effect that the tax on accreted income, which is like an exit tax under section 115 TD, hits you in that situation. And therefore, there was many people had to then, trust had to file appeals to tribunal. Tribunals were flooded with these appeals where they had missed, where the application was rejected only on the ground that the application was filed late and that the commissioner had no power of condonation of delay. So some trusts applied for condonation of delay to the CBDT, and I understand that hundreds of applications went to the CBDT as well for condonation of delay. CBDT granted a one-time extension till 30th June 2024, saying that if you had applied in the wrong list, you could make a application and before 30th June 2024. And by the circular 7 of 2024, they had granted that. But now what they have said is that this power of condonation of delay is now with the commissioner or the principal commissioner with effect from 1st October 2024. So if you have made a mistake, by mistake, you have not understood by what time you should have made the application, you made the application late, the commissioner, and if it is for reasonable cause, then the commissioner has the power to condone the delay. So you don't have to go and appeal to the tribunal, or you don't have to go to the CBDT for the extension. So that, I think, is a very welcome provision, and a large number of trusts will benefit. The question is, what happens if there is a delay from July to September 2024? Because the extension was granted 30th June. I think in such cases also from July to September 2024, if there was a delay, the commissioner will probably dispose of the application only in the month of October onwards, and therefore has the power of condonation of delay from that time onwards. Since this is a procedural amendment, that power of condonation of delay will apply to all applications. I mean, effectively, the commissioner can exercise that from 1st October 2024. Then the next amendment is on relation to the time limit for the grant of registration under 12AB. That has been modified. And currently the position was that he had to, when the application was made, and particularly this is the cases where a provisional registration is being renewed or your 5-year registration is being renewed, that is being done after verification of documents by the commissioner. Now, what has there, the provision was that within 6 months from the end of the month in which the application was made, the commissioner had to pass the order. Now, what is happening is that the number of applications coming in is growing and growing. And I'm sure in September 2025, there will be a large number of applications coming to the commissioners. The question is whether they'll be able to cope with that. So in a sense, in a preparation for that, they've said that, okay, it will be 6 months from the end of the quarter in which the application will be received, rather than from the end of the month in which the application is received. And again, for the first time renewal, that is the automatic renewal, when 21 to 26, that was there, and which extended time was there till June 24. Or for provisional registration, because it is given on an automatic basis, there is no verification of documents. The time limits are unchanged at 3 months from the end of the month in which the application is received and 1 month from the end of the month. So that, I think, remains unchanged. It's just the cases where scrutiny of documents has to be done by the commissioner and before a renewal. It's in those cases that the time limit is 6 months from the end of the quarter instead of 6 months from the end of the month. The one more provision which has come in is under Section 12 AC has been inserted with effect from 1st April 2025. For companies, we have a provisions relating to merger of companies under Section 72A. For merger of charitable entities, there has been no provision. So therefore, the question is, you have 115TD, which is that exit tax, which I talked about, tax on accreted income. Now that applies to merger of a registered trust with any trust other than an entity having similar objects and which is not registered or approved. So if a registered trust merges with an unregistered trust or merges with an entity not having similar objects, then 115TD tax on accreted income applies, and rightly so, because then possibly it could cease to be a non-profit organization, it could cease to be a charitable organization. Now, 12AC says that tax on accreted income will not apply if a trust which is registered under 12AB or approved under clauses 4, 5, or 6 or 6A of 1023C will not apply. If that other trust has the same or similar objects, the other trust is registered under 12AB or approved under clauses 4, 5, 6, or 6A of 1023C, and the merger fulfills other prescribed conditions. So here what they seem to be doing is effectively saying that we will prescribe certain conditions on the basis of which the merger will effectively... now, in any case, of course, the tax on accreted income 115TD is not been amended. So tax on accreted income in any case does not apply today if a registered trust merges with another registered trust having similar objects. So therefore, in any case, that doesn't apply. But here, I think the objective of this is that merger should fulfill other prescribed conditions, is to, in a sense, to lay down what should a charitable trust follow in case of a merger. Under the Maharashtra Public Trust Act 1950, there is a merger of trusts is possible under Section 50A of the with the approval of the charity commissioners. In states where there is no Trust Act, such merger is possible under Section 92 of the Code of Civil Procedure, read with Section 151 of the Code of Civil Procedure. Uh, Merger of Section 8 companies is also possible. As you know, merger of companies is possible under Companies Act 2013. However, there is no provision for merger of societies under Societies Registration Act 1860. The other thing is, of course, what about merger of trusts which are exempt under 1023C, 3AB, 3AC, 3AD, or 3AE? Would that not qualify? I would say that in those cases, again, uh, tax on accredited income in any case does not apply in a situation where it's merging with another entity, having similar objects possibly. But I think this is one area on which perhaps some representation may need to be made. There also some clarity is required. And what are the issues which you face in merger which may need to be notified for the conditions? One is what happens to the accumulation under 11.2 of the merging trust when it gets into the merged trust. Would the merged trust also have to fulfill those conditions and spend that money? Similarly, income opted to be spent in subsequent year, what happens to that? Investment forming part of corpus as of 1st June 1773 of a merging trust, because that will not be part of corpus of the merged trust as of 1st June 73. Whether this would be an eligible investment, that may need to be provided for. Recoupment of corpus or repayment of loan. As you know, if you incur an expenditure out of corpus or out of a loan, that expenditure will be allowed only in the year in which the corpus is recouped, the investment is placed back, or the loan is repaid. Now, in this situation also where the one trust merges into another and one trust has spent out of corpus, thereafter, when the corpus is recouped by the merged trust, that benefit should be given. Similarly, for repayment of loan also, if the loan is repaid by the merged trust, the expenditure was incurred by the merging trust, that benefit needs to be given. So these are probably some of the points which will need to be addressed in the context of merger. In the context of ATG, I think there's a small amendment, National Sports Development Fund. Earlier the reference was to a sports fund which is set up by the government, National Sports Fund. And now this, especially since it's been set up by the government, this has been named. You get, of course, a 100% reduction without any limit. That's the 10% limit also doesn't apply there. Application for Section ATG approval. Earlier, where the approval was being sought for the first time, it was possible only when the activities had not yet commenced, or where the activities has commenced, but no exemption was claimed under Section 11 or under clauses 4, 5, 6, or 6A prior to the application for any year prior to the date of the application. Now, which meant that suppose if you are a trust which had never got ATG so far, because of the fact that you didn't want ATG, you didn't have donations, too many donations coming in, and you said, no, I don't want ATG, and you just had 12A, and therefore you were claiming exemption under Section 11. Now you could not have made an application for now. If you wanted to change, you change your mind, and you could not have made an application under ATG because of the fact that you had claimed exemption under Section 11 prior to the date of application under ATG. So now they said that this will be permissible at any time after commencement of activities. You can make the application. It's not necessary that you should not have claimed exemption under Section 11 or 1023 clause 4, 5, or 6 or 6 or 8. So therefore, you could also have a situation today where a trust has ATG approval. They may choose not to renew that ATG approval for some years. And maybe after 5 years or 10 years, they may say that, okay, now let's again apply for Section ATG approval. That also should be possible now. That is there. And for ATG approval also, where it is after scrutiny of documents, that time limit for grant of renewal by the commissioner, that's been extended to 6 months from the end of the quarter instead of 6 months from the end of the month in which the application was filed. On capital gains, now let's look at this, where this is an important thing, I think affects a large number of SSEs. And for listed equity shares, units of equity-oriented mutual funds, zero coupon bonds, the old provision was for new 1 year holding period. New also amends continues to be 1 year. The long-term capital gains tax rate goes up from 10% to 12.5%. The short-term capital gains tax goes up from 15% to 20%. For unlisted shares, the holding period under the old provision was 2 years. It continues to be 2 years. For a resident, earlier you would have got 20% with indexation. A non-resident was entitled to 10% without indexation. Now both resident and non-resident are put on the same par. It will be 12.5%. For short-term capital gains, slab rates continue for both for resident or non-resident. Listed units of REIT and InvIT, they have been brought now on par with equity shares and units of equity-oriented mutual fund and zero coupon bond. The holding period, which was 3 years, has brought down to 1 year. Earlier, they were entitled to a 10% rate if it was held a long-term capital gain. It will now become 12.5%. The short-term capital gains, again, like for equity, goes up from 15% to 20%. Listed bonds and debentures, the old provision was for 3 years. The new provision is for 1 year. Long-term capital gains tax rate would be, the old provision was for 10%, which will go up to 12.5%. Now, market-linked debentures and specified mutual funds, this is deemed to be short-term. We'll deal with that amendment a little later in the next slide. Unlisted bonds and debentures, earlier it was, the whole provision was 3 years for holding for to be long-term. Now, in all cases, it will be short-term because it's been brought under Section 50AA. The long-term capital gains tax rate was 20% without indexing. Of course, now that question doesn't arise. And it would be always at a slab rates. Land and buildings, which was 2 years, that continues to be 2 years. Old provision was 20% with indexation. Now it will be for long term, it will be 12.5%. And for other assets, the holding period, which was 3 years, is brought down to 2 years. And again, the 20% with the indexation for long term capital gains is brought down to 12.5% without indexation. Now, so on sale of listed equity-oriented mutual funds, today you pay tax only on the amount in excess of 1 lakh. That 1 lakh has gone up to 1,25,000. Now, this limit is applicable for the full year. Now, they said that it will apply for the entire year. So for 1,25,000. So for the pre-23rd July as well as post-23rd July. The question is, pre-23rd July rate is 10%. Post-23rd July it is 12.5%. How will you apply the 1,25,000? I think you can choose to take whichever is most beneficial to you. And obviously, it is first beneficial to claim 1,25,000 post 23rd July, so that your 12.5% is what you save on 1,25,000 and not 10%. Thereafter, your cap gains would be under tax at 10%. That's the way, I think, because which is most beneficial to you. But of course, today, as you know, the problem really is this, that, while the law may be one thing, while you may be, but whether the utility, how the utility will calculate, etc., is something which one will have to wait and see. And, next year, that's the basic exemption that continues to be available for residents. Say, if I have other income of only 2 lakhs and long-term capital gains of 3 lakhs, 1 lakh long-term capital gains I can claim as exempt under the basic exemption. That continues to be available. For non-residents, of course, that was never available, and that position still continues. Now, interestingly, this rate of 12.5% will also apply to funds and FIIs. Foreign portfolio investors today, for them also this will apply. And therefore, I think that's one significant amount of tax collection by the government by this itself. Now, earlier under Section 112, it said that you have to calculate the capital gains in term for non-residents without applying the first or the second proviso to Section 48. Now that the first proviso to Section 48 is not there, so that is so therefore the gains can be computed in terms of foreign exchange by a non-resident, and of course the rate will go up from 10% to 12.5% for unlisted shares. The other thing which you need to keep in mind is, while they've talked about 12 months or 24 months only being the two periods, but I think one thing which possibly is they've missed out is in case of slum sale under Section 50B. The holding period for the business to qualify as long-term capital asset remains unchanged at 36 months. So that is something which, maybe needs to be rectified, perhaps, if they want to standardize it really. Then Section 50AA, as I said, that applied earlier to specified funds. So what they've now done is they've extended it to unlisted bonds and debentures. So, which are transferred or redeemed or maturing on or after 23rd July 24. So, even if you had an unlisted bond earlier, which you had acquired earlier, and which is maturing now on or after 23rd July 24, this new provision would apply. It would be regarded as a short-term capital gain, irrespective of the holding period. You may have held on to it for 5 years, 7 years, etc., whatever is the period, that would be there. The only benefit, perhaps, is to non-residents. Non-residents may say that, yes, the appreciation which I've got on redemption, if I'm on redemption, I've got something extra, that may still amount to interest under the DTAA because of the definition of interest under the respective DTAAs. So this premium may amount to interest under the DTAA, and therefore they may get the benefit of the lower tax under the DTAA, irrespective of what the provision is under domestic law. So that is the other very important provision, is the definition of specified fund. So the way they had defined it earlier was in a negative manner, in a sense that if they don't have 35% in domestic equities, so therefore fund of funds was not eligible, or ETF investing in foreign assets was not, foreign shares was not eligible. So gold funds were not eligible. They were all falling under 50AA, and they were not eligible for long-term taxation treatment. Now that was, I think, an unintended this, because that amendment came in at the time of passing of the finance bill last year. And not at, it was not a part of the finance bill so far as the specified fund is concerned. It was originally owned, so that was not intended to be. Now what they have done is that uh, th- there's an amendment in the definition of specified fund, but this is with effect from assessment year 26-27. Now, one more thing you have to remember is in this budget, you have different dates from which the amendment apply. 23rd July, 1st September, 1st October, you have 26-27, you have assessment year 24-25. So for each amendment, I think it's advisable that you look at from which date it applies. That's something which you will have to do. Now, this amendment is from 26-27, and the reason for this is possibly because to qualify as a long term, it will have to be for a period of 2 years. And therefore, because this, so there, now the amendment is that a mutual fund which invests more than 65% of its total proceeds in debt and money market instruments, or a fund which invests 65% or more of its total proceeds in such a fund which is investing 65% in debt and money market instruments. So therefore, only debt funds will, or a fund of debt funds will get covered in this. So the gold fund, the foreign ETFs, etc., will go out of that and will now fall under the normal provisions. So therefore, if they're held for period of 2 years, therefore then they will qualify as long term and with for the rate of 12.5%. So that is so they will now not be specified funds. So that is the so far as the impact on real estate, gold, unlisted shares is concerned. Now, cost indexation has gone away completely. You have the second provision of Section 48 saying that for any transfer on or after 23rd July 24, this will not apply. So you have a long-term capital gains tax rate of 12.5%. So whatever is the net sale consideration and the cost of acquisition plus the cost of improvement, that would be taxable. And so without any indexation at all, irrespective of when you bought it. The only thing is that for an asset acquired prior to 1st April 2001, you can substitute the fair market value as on 1st April 2001, which is permissible under Section 55. That is the only thing. But from 2001 till the date of sale, you will not get any indexation at all. So you will get the benefit, as I said, that effectively the market value as on 1st April 2001. There also for immovable property, as you know, that only the stamp duty valuation as on 1st April 2001 can be taken and not any other fair market value. Now, therefore, if you look at this really, considering the long-term capital gains rate of 12.5% versus 20% earlier, if the capital gains index, grew by around 4 to 5%, where the appreciation is less than 6.45% or to 8.06%, then you're worse off. But if your appreciation is more than that, then you're better off. Again, it depends on what period, because the capital gains index, as you know, inflation was much higher in earlier years. In recent years, it's been comparatively subdued. But yes, in the last 1 or 2 years, it has been fairly high. So the question is that now what will happen is that if today you don't have that appreciation of, say, 8% on a compounded basis, then instead of getting a capital loss, which you have got by applying the capital gains index or having only a nominal capital gains, you will pay 12.5% on that entire appreciation which you have got. Now, for longer holding periods, particularly the CAGR may be much lower. And also what will happen is that the inflation over that period will be longer, and therefore you may end up paying tax on the entire inflation during that period. And that's one risk. So you can have a capital loss only if the sale is actually below cost or because of transaction expenses and it results in a loss overall. So that is the only situation. So you can't have a capital loss due to indexation now, because that was a big shelter to many taxpayers, I think, which was there. But a couple of points in relation to immobile property you need to remember is that now, since the capital gains on the sale of immobile property will be higher, as opposed to without indexation, you will get it. The reinvestment requirement to claim 54 or 54 EC exemption would also be higher, because it's the capital gains which has to be invested. So far as 54F is concerned, it's the net sale consideration, so therefore that may not change. But 54 and 54 EC, the investment amount may require to be higher. Again, earlier, say there might have been a situation where your capital gain was, say, 8 crores. And now without indexation, it will be say 12 crores. Now what will happen, and you bought a house, now the restriction is that what you can claim under 54 is for the cost of a house of only up to 10 crore. Now, therefore, what will happen is that out of 12.5 crores, only 10 crore will be exempt, 2.5 crore you will end up paying tax. So this is another impact which may happen, particularly for in the larger cities in this case. Coming to the next significant amendment which we need to understand, and that is in relation to buyback of shares. So far you had, because of the fact earlier, you had section 46A, which says that a buyback of shares would be subjected to capital gains tax and not tax as deemed dividend. So there was doubt whether it was taxable as dividend. They said that no, it will be taxed as capital gains. So that was the position. Then they found out that yes, non-residents were taking advantage of the treaty exemption for capital gains, and therefore a buyback tax was introduced, and that was under section 115 QA, and that was applied only to unlisted shares initially. Gradually, that was extended even to listed shares. And so they said that the company will pay a buyback tax of 20% plus surcharge and cess. The company will pay the tax on the difference between the issue price and the buyback price. On that amount, it will pay the tax. The shareholder will be exempt under section 1034A. So that was the position. Now, what they have said is they realized that instead of paying dividends, companies were resorting to buybacks. And therefore, they felt that no, they're saving, instead of paying 39%, which the shareholder would have paid, they're paying a tax of only effectively 19%. Because since the company is paying the buyback tax, and if you add up the buyback tax plus the amount which is given as the buyback price, on the gross amount, the tax effectively works out to only around 19%. So therefore, they felt that they're getting away by paying much lower tax. And therefore, now the provision has come with effect for buybacks from effect from 1st October 2024. The full buyback proceeds will be taxable as dividends in the hands of the shareholders. The buyback tax will not apply from 1st October 2024. Obviously, the exemption under 1034A will also not apply. No deduction will be allowed to the shareholder for any expenditure under section 57(1). He will not get a deduction even for the cost of shares or interest paid on loan for acquiring the shares, etc. Nothing will be allowed in that against this amount which is taxed as dividends, buyback price which is taxed as dividends. The entire cost of shares will be allowable as a capital loss under section 46A. So the consideration will be deemed, value of consideration will be deemed to be nil. 46A will apply there, and you will get a capital loss. If you held the shares for more than 2 years, it will be a long-term capital loss. So therefore, what will happen is that the shareholder will pay tax on dividends at 39%, and he will be able to set off this capital loss perhaps at 12.5% plus surcharge and cess, which effectively works out to 14.95%. So therefore, the shareholder is much worse off under buyback, and I don't think any shareholder would want to go in for a buyback under such circumstances. Now, the other thing which they have provided is that it will only be applied in respect of a buyback under section 68 of the Companies Act 2013. So far as buyback tax was concerned, earlier this was also in respect to the reference was to section 77 of the Companies Act 1956. Then they said that under any provision they amended the law to say any provision of the Companies Act. And therefore, then the question came up that what about redemption of preference shares? Now there, the view was that yes, perhaps redemption of preference shares would also be subject to buyback tax because of the fact that it is purchased by a company of its own shares. Because the section, if you look at the Companies Act, it said that no company shall purchase shares except redemption of preference shares, etc., or a buyback contemplated under so. That was and therefore the view was that redemption of preference shares was also covered. Now, redemption of preference shares will therefore not be covered by this new provision, taxing it as dividends. Therefore, it will be taxed under section 46A as capital gains tax, and it would depend upon whether it is long-term or short-term in nature. So therefore, that is something which will, but this is again, as I said, with effect from 1st October 2024, because till then the provisions of buyback tax still apply till 30th September 24. Now, because of the consequence as taxation as dividend, you have a separate clause F added to the definition of dividend under section 222. TDS would be deductible by the company on the buyback price at 10% from the case of shareholder. In case of the non-residents, dividends, as you know, are to be taxed at 20% plus surcharge and cess, and therefore TDS would be at that rate. But the question there is then, so far as the taxability in the hands of non-resident, the company may consider it as dividend and deduct at 20% plus surcharge, it says, the TDS. But can the non-resident claim the advantage of a double tax avoidance agreement and take a view that this is not dividend as defined under the Companies Act? Now, there, I think one would have to look at the definition under the respective treaty, and perhaps it may not qualify as dividend. It may still qualify as gains arising on alienation of capital asset. And therefore, for a tax treaty, the tax treatment may be different. It's something which one will have to examine the provision of a particular treaty. And possibly, I think one may be non-residents may not get impacted. Now, what you have to remember is that this taxation as dividend doesn't depend on the accumulated profits of the company. Whether the company has accumulated profits or not, or whether the share premium is being utilized for that, etc., doesn't matter. The whole thing will be still taxed so far as the entire buyback procedure will be taxed. The question then is, would the amount treated as dividend under clause F now under for the buyback price, can you reduce it from the accumulated profits for consideration of future dividends? There have been decisions in the past in the context of deemed dividend under 222E that if something is treated as deemed dividends, then when future actual dividends are declared, then this amount can be set off and it will can't be doubly taxed. Now, here, I think this argument is possible there. This is something which one can examine. I think it's possibility of set off is there. Now, what about corporate shareholders? Say if you are a company which is a shareholder and the shares are being bought back, will it be eligible for Section 80M deduction? I think yes, because this will be dividends and so far as the Income Tax Act is concerned, and this would possibly qualify for the purpose of Section 80M deduction. Now, I think one of the things which possibly needs representation is that it is extremely unfair to tax something which is not by real income. You say, I will tax dividend at 39% and the capital gains, I will allow you capital loss, which will be at 14.95%. I think that's something, if you tax at least the net amount as dividends, I can understand that because that is profits which are going to a shareholder, which are being distributed to shareholder. So it should really have been the net amount which is taxed in the hands of the shareholder. That I think would have been maybe that's something which needs to be represented. It's something which needs to be considered. Then coming to this gifting, transfer and exemption for a gift or a will or a irrevocable, that currently the provision was under Section 47(3). Any person transferring a capital asset under gift, will, or an irrevocable trust was exempt that was not subject to tax under Section 45. And there were companies which were transferring assets without consideration, claiming exemption as gifts. We have the Bombay High Court in the case of Bakhtawar Construction Company, where, of course, this was a 263 matter, where the Bombay High Court said the assessing officer has taken two possible reviews that, yes, it was exempt under 47(3), and therefore that would, 263 cannot be resorted to. The Mumbai Tribunal and Ahmedabad Tribunal have been cases where they said that, yes, it is exempt under Section 47(3) because of the fact that it does not say it is without consideration, and therefore it would be eligible as a gift. A gift need not necessarily be out of natural love and affection. Of course, there is the Madras High Court decision in the case of Reddington, India, where the Madras High Court looked at a corporate restructuring situation, and they said that in a situation of corporate restructuring, they have not said that it is is a gift or etc. And they've said that this is for purpose of corporate restructuring, and therefore it would not qualify under Section 47(3). That was the view, though it is without consideration. And though a company can give a gift, it was the view, because they have not said it's a gift and this is for the purpose of corporate restructuring. The resolution mentioned that, and it was on that ground that the Madras High Court said. Now, the amendment is seeking to plug this, and this was particularly resorted to in the case of family settlements. What was happening is, in a family settlement, as you know, there is a Bombay High Court decision which has said that a company cannot be a party to a family settlement. Now, in a family settlement, you may want that a company is holding certain property, and that property is to be transferred to one of the family members or to a company of one of the family members. Now, that was where this was being used, saying that, okay, doesn't matter if that entity pays tax because this is as part of the family settlement and therefore it will be exempt. That was one thing. Sometimes also you may want to do a transaction under 47(3), claim exemption under 47(3), so that the provision of Section 50CA do not apply. 50C or 50CA do not apply. So therefore the question is now that this exemption is restricted only to individuals and HUFs. So if a company were to transfer a capital asset as by way of a gift, it would no longer be exempt under 47(3). But would it be liable to capital gains tax? Because there has to be consideration accruing as a result of the transfer for 45 to apply. Can one take a view that, yes, the provisions of there is no consideration received or accruing as a result of the transfer of capital asset? If you look at the Bombay High Court decision in the case of Jai Trust, and there they said, in case of Jai Trust, the Bombay High Court looked at two things. One is they said that, yes, 47(3) applies in this situation. And the second thing is that they said Section 45 provides that any profits or gains arising from transfer of capital asset, that means there has to be a consideration received as SSC. Only where there is consideration received can the profit or gain be measured. This is evident from Section 48, which says that the income chargeable on head capital gain shall be computed by deducting from full value of consideration as a result of the transfer of capital asset. Consequently, provision of Section 45 pertaining to capital gain would not apply. So that was the view which was taken by the Bombay High Court, that there has to be a consideration. Unless there's a consideration, it cannot be charged to tax. So therefore, this is one area where there could be still some debate. Though, of course, you do have the provisions of Section 50CA, 50C, or 50D also, which whether 50D is where the consideration is indeterminate. When there is no consideration, can one say that the consideration is indeterminate? I think 50D may not apply in that situation. But so this is something which could be an area of dispute which could continue. Coming to 55(2)(AC), and that was in case of shares which were unlisted as of 31st January 2018. As you know, 31st January 2018 was the cutoff date for grandfathering the capital gains benefit under 1038. So listed shares, you could substitute the fair market value as of 31st January 2018 for your actual cost if the share was acquired prior to 31st January 2018. For unlisted shares which became listed after 31st January 2018, you could substitute the fair market value by taking the indexation up to 31st January 2018, and that could be from the cost of acquisition. Now, there the condition was that if it was sold, listed, it was a listed share which was sold, which was subject to STT. Now, in an offer for sale, where the promoters make an offer for sale in a public, in an IPO, post January 2018, they pay STT. STT applies to an offer for sale. So they are paying that. But the shares at the point of time of the offer for sale, the shares at the time of allotment of the shares, transfer of the shares from the promoters to the allottees in the IPO, the shares are not listed. They get listed 2 or 3 days after the allotment is finalized. So therefore, technically, it is not listed on that date. And therefore, the view was being taken by some promoters that since the competition provisions fail, the shares are unlisted. They were unlisted and they are unlisted at the time of transfer, though STT is paid. So the competition provisions fail and therefore no capital gains tax liability arises at all. So that was the view which was being taken by promoters. And there were many IPOs where this view was taken. Now, therefore, they have said there is a retrospective amendment with effect from assessment year 2018-19, specifically covering such transactions. And where they're saying that you will get a cost of indexation up to 31st January 2018. Till that, you can claim that. That will be your cost of acquisition. And it will apply even to shares which are offered as part of the offer for sale by promoters in an IPO post January 2018. So that is the amendment. So what will happen is that all those promoters who have claimed exemption in the past, they will now be subjected to tax. And possibly, I think, because of the reassessment procedure, provisions, possibly reassessment notices could be issued to such promoters, I think, in such situations. And, the tax could be... but the time limit, of course, once the budget is passed, there will be a very short time span when this becomes law, and 31st August, because for assessment 18-19. So that will be the test. So far as business deductions are concerned, of course, this, as I said, for non-government employers, that 10% to 14% for, the employee gets it. Even the employer can get it as a deduction. That limit is enhanced. Income from letting of a residential house. Now, this will be taxable as income from house property and not a business income. Because you have situations where people let out their houses through Airbnb or other online portals, or the stock held by developers, they let it out. And they were claiming that this is business income. They were claiming expenses against that. Now, this will be taxable as income from house property. So the expenses will be limited to your boostable taxes and 30%, etc., or interest paid. This, of course, applies only to letting of a residential house. It does not apply to commercial real estate. The other important amendment is in Expression 3 to Section 37(1). Now, as you know, this was last year, they had extended the provisions, and it currently applies to expenditure incurred for a purpose which is an offense prohibited by law in or outside India, will not be allowed, or to provide a benefit or purpose to any person in violation of any law, rule, regulation, or guideline applicable to the person. This was to cover those medical samples, etc., which are given, or benefits given to doctors. That was to cover that. So they said that that expenditure will not be allowed, or expenditure to compound an offense under any law outside India. That was the. Now it is extended to expenditure incurred to settle proceedings in relation to contravention of a notified law. So the law will be notified, and any amount paid for settlement of any proceedings under that contravention of a law. Now, what is the difference between contravention versus offense? And again, here this talks about settlement, and that is a compounding. Earlier talked about compounding, now you are talking about settlement. So if you look at 337 of the General Clauses Act, it says offense means any act or omission which is made punishable by any law for the time being in force. And Black's Law Dictionary defines it as a violation of law or a crime, often a minor one. But a contravention is an act violating a legal condition or obligation. That's Black's Law Dictionary. And perhaps, I mean, one situation could be, say, for instance, there could be a violation or infringement of a patent law, a violation of a patent law, whereby you use the patent of a registered patent of somebody else is used. And you settle that if patent law is tomorrow notified and you settle that, the proceedings brought by that person. Now, that is not compounding of an offense. It's a violation, it's a contravention of a notified law, if that law is notified. And you're paying settlement proceedings. So that could be the sort of situation. So it's not necessarily amount paid to the government for compounding, but it could be covered, settlement amount paid to any other person also could get covered. And that's something which it's a very wide in scope. But the only good part is that the law will have to be notified. So at least you'll know which laws are covered. That's something which I think is. The other important thing is on partnership firms. The 40B limits the deduction to remuneration to working partners by a partnership firm. Currently, 90% of the first 3 lakh of book profits or 1,50,000, which is higher. And the balance book profit, 60% is allowable. That's the maximum remuneration allowable. Now, this 3 lakhs is being increased to 6 lakhs. So you can claim up to 5,40,000 if you have book profits in excess of 6 lakhs. Or if you don't have book profits or the book profits are less than 6 lakhs, then up to 3 lakhs you can claim, whichever is higher. With effect from assessment year 25-26. So therefore, now very often many partnership deeds had reproduced saying that first 90% of so much and thereafter 60%, etc. Now you may need to amend the partnership deeds of these firms in case you want to provide for this higher remuneration for financial year 24-25. So that is something which you may need to keep in mind. The other thing is this, what we have popularly referred to as angel tax. Now, which was a tax on share premium on issue of shares by unlisted companies. So there you had 56 to 7B, which said that the excess of fair market value will be taxable. Last year, this applied only to issue of shares first to resident investors. Last year, this was extended to non-resident investors as well. And you had very complicated valuation provisions, which, the valuation rules were changed. Earlier, it was only DCF or book value. Then they changed it and it became the various alternates this thing were given last year. But from this year, they realized that, yes, this is still creating a problem. There is a lot of litigation still happening. And it has been deleted with effect from assessment year 25-26. So therefore, any allotment of shares on or after 1st April 24, because it's not the date of receipt, but it's the date of allotment which will matter. So if there's an allotment on or after 1st April 24 by an unlisted company, this provision will not apply at all. It would apply still to earlier transactions. Is this amendment retrospective? I think it's a difficult thing to argue, but yes, perhaps one can say that this is really clarificatory because they realize that this is a problem because the FM made a statement that the government is looking at a method to end the earlier litigation, which shows that this was perhaps causing unintended difficulties. So therefore, one will have to now maybe see that what happens to the past litigation. Does the government come out with some way to end it? And I don't think the Vivad se Vishwas scheme is something which will, because there you're just giving up, you're paying the tax, and sometimes the amount will be quite substantial. Out of your capital, effectively, you're paying the tax. Now, the important thing is that today, yes, this litigation will not happen in the future, but you need to remember that Section 68 still applies. And if you have a resident investor who is invested in your shares, the source of the source will still have to be explained to the satisfaction of the assessing officer. Otherwise, it will be taxed under Section 68, and the tax thereon is 60% under Section 115 BBE. So therefore, now one hopes that this will now not give rise to this litigation under Section 68. Now that is the only thing which one will, one hopes that this will be under control. So far as TDS is concerned, I think TDS on the rates, just on rationalization. So they've reduced many rates from 5% to 2%, which you can just go through. E-commerce operator from 1% to 0.1%. But the worst part is that now there is a TDS on salary, remuneration, interest and bonus or commission by partnership firm to partners with effect from 1st April 2025. So this applies where it exceeds 20,000 rupees. 194T is the relevant provision at the time of payment or credit, whichever is earlier. And it does not apply to share of profits of partners. Now, if you have a remuneration which is linked to your book profit, as you said, 90% of the first 6 lakhs and 60% of the balance, and the remuneration is determined only at the end of the year, but the drawing may be made on a monthly basis. So there will be a practical difficulty in deducting TDS. How do you determine how much of the drawings is attributable to remuneration, how much is share of profit? Because that you will really know only when you draw up your profit and loss account at the end of the year. So therefore, there could be a mismatch between the TDS and the remuneration if you do it on some assumed basis. That is one problem. The second problem also, there could be a mismatch between the TDS and the taxable remuneration because of the fact that only the allowable remuneration is paid taxable in the hands of the partner. And allowable remuneration, as you know, will be determined under Section 40B only because of what is your book profits. That you will know only at the end of the year. So if you paid a higher remuneration, even if it was fixed remuneration, say you paid a remuneration of say 7 crores, you paid a remuneration, and at the end of the year you realize that the allowable remuneration is only 5 crores. Only 5 crores will be taxable in the hands of the partners. Now your TDS would have been deducted on 7 crores in that situation. And therefore, there would be a mismatch. And as you know, then you will get a notice asking that there is a mismatch. You should have declared a higher income, etc. A defective return, this, etc. All those things will come, or a notice under 143(1) proposed adjustments, and then one has to answer those. And so these are really the problems which will arise. The one way, of course, is whereby you then opt to pay a fixed remuneration only. But again, the question is, if your book profits falls, still this mismatch will be there. But at least you won't have the problem of determining how much is towards the fixed, how much is towards remuneration, how much is towards the share of profits. The question is, what about payments to non-resident partners? Would 194T or 194 apply, or would 195 apply? I think 194T being the specific, because it does not exclude payments to non-residents. Payments to non-resident are normally covered by 195, but 195 is a general provision applicable to non-residents, while 194T specifically applies to partners or partnership firms. I think the specific would prevail over the general. Section 194T, in my view, should apply in this situation and not Section 195. On immovable property, this limit of 50 lakhs, how do you determine it when there are multiple purchasers or there are multiple sellers? Because there are already tribal decisions which I've reproduced here, where they say that this applies vis-a-vis each purchaser and each joint purchaser, each joint seller. So you have to look at what is the payment being made by each joint purchaser to each joint seller, and that's how you look at 50 lakhs. Now, with effect from 1st October 24, they're saying that you aggregate all that. The question is, what happens if the purchase happens at different points of time? Of course, practically it may be difficult to do this purchase at different points of time, but I think this is something which technically it doesn't apply the provision, because it will apply for the sale of the property, if assuming the property. But if I would say if the property sale happens in the same year, possibly the tax authority may say that in substance there is a transfer and therefore TDS ought to have been deducted. So that is the view which may sort to be taken. Others that there is so far as where you have a situation where 194C as well as 194J apply. People were taking a view that no, I will apply 194C and not 194J. They said that no, you have to apply 194J in that situation, because 194C would not apply to that. A very important thing is under 194Q, on purchase of goods exceeding 50 lakhs, you have to deduct TDS at 0.1%. There was no provision for certificate under 197. Now the requirement has come in with effect from 1st October 24, because a lot of money was getting locked up in this TDS on purchase of goods. So far as the seller was concerned, it was a large amount. Now, if you get a nil certificate, then what you need to remember is that TCS under 206C 1H may apply. you will need to apply for a lower deduction certificate there also, because there also that provision has been introduced there. So far as tax withheld outside India foreign taxes is concerned, now 198 has been amended to say that it will be added to the income, just as TDS you have, that it will be deemed to be income received for the purpose of computing the income. The objective is that they're saying that taxpayers were claiming that no, it's a deduction, it's not taxable, the foreign taxes is not taxable, and as well as claiming foreign tax credit, and the double benefit was being given, and therefore it is to plug that. But the way it has been, this is that in respect of which SSC has been allowed credit, only in that this applies, it's deemed to be income. So what about foreign TDS where credit is not allowed due to foreign tax credit rules? They will have to proportionate credit, etc. What happens in those situations? I think there possibly, there is this Bombay High Court decision in case of Reliance Infrastructure that foreign taxes paid abroad to the extent not allowable as credit are allowable as a deduction under Section 48(2). Of course, there the question is whether that is the right decision or not is a question which will arise, because there have been other decisions of, in the context of different other taxes. And really, what is your real income under this situation? Is it the gross income or the income net of foreign taxes? I think this is a debate which will continue, and this will possibly inflame that debate. And again, there is a controversy in the context of domestic TDS today as to it is deemed to be income, but of which year? So is it in the year of deduction of TDS, or is it in the year in which that income is offered to tax? Because I will get credited in the year in which income is offered to tax. I think the better view is that it should be credited in the year in which the income is offered to tax, and this is that year that it will be deemed to be income is the better view, is my view of the matter. Then certain time limits under TDS correction statements that's been amended. Time limit for declaration SSC in default, there have been some changes over there. Penalty under 271 for delay in furnishing of TDS or TCS statements is not leviable currently for delay up to 1 year. Now that has been brought down to delay of 1 month, which effect from 1st April 2025. So penalty could be levied over there. It will apply to defaults after that date, is the view which I have. Prosecution under 276B, which, earlier prosecutions were launched even for small delays. Now they say that delay for a period of up to 1 month from the due date of, if the TDS has been paid on or before the due date of filing of TDS statement for that quarter, then there will be no prosecution. But I think, probably this should have been really up to the due date of filing of the income tax return, because it's at the time of tax audit, it's at the time of filing of the return that one realizes that TDS has not been deducted. And I think the way this being a procedural amendment, possibly it would apply for not for default after 1st October 24, but for commencement of prosecution proceedings after that date, this provision would apply, this amendment would apply. Certificate for lower TCS, as I said, for sale of goods, that is now you can apply for that. Credit for TCS. Now, this was one thing that under LRS, for instance, you send money for a minor, TCS was deducted from in the name of the minor. Parent could not claim credit because unlike Rule 37BA, where you have credit being available for TDS by a declaration being given to the deductor, there was no such provision so far as TCS is concerned. And therefore, you had to file an application, you had to file an appeal, the parent would claim it, file an appeal, and then the commissioner appeal would allow the benefit, etc. Now they're saying with effect from 1st January 2025, credit will be available to the other person. I'm sure that the rules will be amended to provide for that. Luxury goods, they want exceeding 10 lakhs, they want to have TCS, they're extending that. The time limit for correction statement, they're limiting it to 6 years. Currently, there's no time limit. On delayed payment of TCS, if you collect the TCS and don't pay, higher TCS interest of 1.5% would apply. And the power to exempt notified entities. Refunds, there is now a provision currently where the assessing officer under Section 245 can withhold a refund where assessment or assessment proceedings are pending. And he's of the view that the grant of refund is likely to adversely affect the interest of the revenue after recording reasons in writing and with the previous approval of principal commissioner. Now, that withholding can be up to the date of completion of assessment or reassessment. And for that period, no additional interest will be paid at 3% per annum. Because as you know, if it's beyond a period of 6 months, then 3% per annum is there. Now, with effect from 1st October 24, the amendment is that there's the requirement of a review that grant of refund is likely to adversely affect the revenue is deleted. So therefore, today, the reason saying is that anyway he's recording the reason in writing. But tomorrow, nothing stops the assessing officer from saying that my budget, this thing is being, by giving this refund, my target is getting affected, and therefore I'm withholding the refund. I think this is an extremely unfair thing, so therefore it's something which is, any reason can be recorded by the assessing officer. And that is something which, and again, the time limit given now is extended for 60 days from the date of assessment or ESM without this additional interest. Now, for a taxpayer, it is 30 days to pay the demand. Why should this be 60 days? Probably 30 days would have been a more reasonable thing. That's something which now, the power of remand in best judgment assessments, CIT appeals has been given that power. He may also, of course, decide such cases on merits at his discretion. Minor change in the time limit for filing appeals to the tribunal. Now, CIT appeals, of course, again, the order of black assessment appeal is permissible. Tribunal, of course, monetary limits, the FM has announced that these limits for filing appeal by the department will be increased from 50 lakhs to 60 lakhs for tribunal appeals, 1 crore to 2 crore for High Court appeals, and 2 crore to 5 crore for Supreme Court appeals. That we'll yet have to see the circular and whether the exceptions which are there in the earlier circular continue and applicable to pending cases. In the past, it has applied to all pending cases. This will hopefully, in this case, also it will apply. But the problem is that the disposal of the first appeals, which are today, there's a backlog of 5 lakh appeals plus at the commissioner appeals level. The commissioner, finance minister has said that I plan to deploy more officers to hear and decide such appeals, especially those with large tax effects. There have been appeals which are pending for 6 years, 7 years, and nothing has happened. Even if you make an application, etc., nothing is happening. One hopes that that is now given priority. You need really to have a Vivad Vishwas saying that all those appeals will be decided in favor of the taxpayer, because those are really genuine appeals. Otherwise, they would have settled it long back. The taxpayer would have settled it long back. But this is something which needs to be done if the department cannot handle those appeals. Unfortunately, that I think we'll have to wait and see, because last year the joint commissioner, deputy commissioner were given powers for certain orders passed by CPC, and still the dependency is not gone down, and that is something which is a matter of concern so far as taxpayers are concerned. Penalties for failure to for the Black Money Act, that was did not apply if you had a bank account. The requirement of filing of return or for non-disclosure, wrong disclosure did not apply if you had a bank account with value not exceeding 5 lakhs during the year. Now, from 1st October 24, they are amending it, saying that if non-disclosure of any assets other than immune property, where the value of aggregate value does not exceed 20 lakhs. Now, when you're talking about value, are you talking about cost or are you talking about fair market value of the asset? And end of the year or during the year? If you look at the Black Money Act, the explanation to Section 42 says that for determining the value equivalent in rupees, SBI TT rate, as of the date on which value is to be determined, is to be taken. And explanation 43 also says value equivalent in rupees to be determined value. So therefore, that is the problem there. I mean, there is no clarity. I think in terms of disclosure in the return is concerned, it is the cost which you're required to disclose. And therefore, possibly a view is that it should be taken as the value cost. That's one thing. But I think on this, some clarity is required. Now, the question is whether this could apply for past cases and retrospective. One can maybe rely on the FM speech and the explanatory memorandum for this, where they said that, that this is very low and results in many penalties, with the asset value itself is less than the amount, the penalty amount. So therefore, one can say that this is for non-residents and for liaison officers, for SFT, there is some penalty, etc., which is being come in, which is increased. Gift City, I don't think we want to. And presumptive taxation for non-residents, again, we can skip. Tax clearance certificate, I think I'll just deal with that for a couple of minutes. This now, this was extended to earlier, it applied where there were arrears under the Income Tax Act. Now this is extended to arrears under the Black Money Act. And, there was people thought that, everybody going abroad and having tax arrears of more than 10 lakhs is now required to get a tax clearance certificate. But what you need to remember is that this is CBT Instruction 1 of 2004, and which says that, persons who are domiciled in India are only required to furnish PAN purpose of visit outside an estimated period of stay outside India. And persons in respect of whom circumstances exist, which in the opinion of a tax authority make it necessary for such obtain, will be required to obtain such certificate. And a person can be asked to obtain a tax certificate, clearance certificate only after taking approval from the Chief Commissioner. So the board has directed that a tax clearance certificate as required under first proviso to 231A may be required to be obtained by a person domiciled in India in the following circumstances. Where the person is involved in serious financial irregularities and his presence is necessary in investigation of cases under Income Tax Act or Wealth Tax Act, and it is likely that a tax demand will be raised against him. And secondly, where the person has direct tax arrears exceeding 10 lakhs outstanding against him, which has not been stated by any authority. The Chief Commissioner, after satisfying himself that the departure of such person from India will prejudicially affect the interest of revenue, may authorize the AO to require that such person obtain a tax clearance certificate. The AO, therefore, thereafter shall inform the immigration authorities accordingly. So, therefore, it is only in these limited circumstances that this requirement of certificate is there. It is not in all cases. Equalization levy on e-commerce operators from 1st August 24, it goes away because the law is complex and the law was always complex. One wondered what was the need. And now taxability of e-commerce operators, foreign e-commerce operators would be governed by the normal provisions. In most cases, because of treaty, they would be exempt. But in a non-treaty country, the significant economic presence test may need to be applied to determine whether there is a P in India or not. And then on prohibition of Benami Transaction Act, there are certain amendments which have been made, time limits laid down for the furnish of expression by the Benamidar. That's been now a time limit of 3 months has been laid. Certain other time limits for provisional attachment have been drawing up a statement of case. There is a power to give immunity either to the Benamidar or any other person if that person is willing to make full and true disclosure of the circumstances leading to the Benami transaction. Obviously, there is no immunity can be given to a beneficial owner. But that immunity which is given to that Benamidar or other person can be withdrawn also for non-cooperation with condition of tender or for willful concealment or for giving false. And on withdrawal, then the person can be tried and also be liable to penalty. So that I think is the amendment so far as the Benami Transactions Act is concerned. Well, I think that covers broadly the amendments in this budget, which I was supposed to cover. Thank you.
Thank you, Piyush sir and Gautam sir, for such a wonderful session. We have received a couple of questions. We shall take them one by one.
Sure.
So the first question relates to the capital gain amendments. What will be the tax rate applicable on the unutilized amount parked under capital gains account scheme? Will the same be eligible to be taxed at 12.5% even if LTCG rate was 20% when amount was parked?
See, here I think what is happening is that because your long-term capital gains arose prior to 23rd July 24, you got the benefit of indexation. You park that money in capital gains account scheme, it now becomes taxable in the third year because you have not utilized that capital gains account scheme money. Now, here what has happens is Section 54 deems it to be income in the year, in the third year. It does not change the date of transfer if you look at it. So your date of transfer still is prior to 23rd July 24, and this rate of 12.5% applies to assets transferred on or after 23rd July 24. It does not apply to assets transferred before 23rd July 24, where the rate continues to be 20%. So therefore, in my view, as per the law, it would be 20% which will apply.
Okay. Now, other question is in relation to buyback. So in case of buyback, if the shares are kept as stock in trade, can the loss be treated as business loss?
So the question there is that when you see in the buyback, what happens is that you're receiving the money and that money buyback price is taxed as dividends. Now, so far as your stock in trade is concerned, the stock in trade itself reduces by that amount because those shares are no longer in existence. So automatically you get the benefit of a business loss is the way I would look at it. And there, I think you cannot claim again a capital loss because this was never held as a capital asset. So 46A would not apply at all. But automatically your business income would be lower because this will not form part of your closing stock.
Other question is whether income from commercial shop can be shown under business receipt.
See, the question is letting off property, whether it is a business or not. Say, for instance, there have been a number of decisions which say that letting off a mall by a mall operator, that is a business because he not only lets out those shops, but also various other services are provided along with that, etc. And therefore, it has been held to be business. You have the Supreme Court decision in the case of Chennai property saying that if it was in the case of your articles of memorandum, it's one of your objects of letting of properties, etc., then that could be business income. Now, therefore, I think one has to look at the facts of the case, whether letting is business or whether it is income from house property. There are various factors which will go into it, just like in the context of shares, whether it is business or capital gains. So here also you have to look at various factors. As does it have the normal this thing of a business? So is there any activity that you're doing besides a pure simple letting out? So therefore, that is what you really need to look at. If it's a pure and simple letting out, though you may be letting out 10 shops, that may not amount to a business unless you fall under the Chennai properties, this thing. And where again, one has some doubts as to whether if the matter were to be looked at again by the Supreme Court, whether that would be upheld or not is a question mark. I think that's
So, Gautam bhai, I believe so. This amendment will not impact commercial property.
it will not impact commercial property.
What is the current status? It will continue depending
Correct.
upon each
Commercial
factor.
properties, as I said in my presentation, it will not affect commercial properties. So if today it is letting of offices or letting of a mall or, it will not affect that. It will apply only to residential property. It will not apply also to letting of land. So it will not apply.
So the leasing company which only deals in the residential premises, now they will be affected, I think so. Even if their business is to lease, acquire residential property and lease
Yes. If they are letting residential property, and I think most of the REITs, etc., the question is whether what about REITs? Now, REITs, I don't think they are letting residential property. All of them are office properties, and therefore they will not get impacted, is the way I look at it.
Okay.
The other two question is in relation to the TDS applicability on remuneration from partners. So the question is that remuneration to the working partner is usually computed at the end of the year on closure of the books. However, the partner may be drawing certain sums of money. So will this drawings will also be subject to 194T? And other question is because it is related, so I'm just taking that question also. So how the practically 194T will work, as allowable remuneration is determined only at the end of the year when the distribution happens.
Yeah. So, the way I would look at it is there are two methods to do it. One is that you change your remuneration to a fixed remuneration, saying that, okay, based on the past experience, saying that, okay, this is my reasonable profit which I anticipate. And that may apply perhaps for professional firms, it may work. But for business firms where business income goes up and down substantially, it may not work. The other way to do it is that look at last year, what was the ratio of the drawings, how much constituted remuneration, how much was share of profit which you apportion at the end of the year, and apply that ratio throughout the year. In March, you finalize your accounts before 30th of April, determine what will be the modified ratio and adjust it in the month of March accordingly. So that's the other way of doing it, because really what you're doing is the drawings are being adjusted against the remuneration and the share of profit. So that is but this is a practical difficulty, I think, which the lawmakers perhaps have not realized that this is going to be because most of the partnership firms do provide for, as a percentage of the profits. This is something which I think maybe, the direct tax committee can take this up with because this will affect a large number of professional firms as well as business firms also. But, there needs to be some sort of, because what is happening is, TDS is only changing that today I was paying advance tax. Instead of paying advance tax, there will be TDS. And I will still have to pay advance tax on the differential, if you look at it in most cases. Now, therefore, really, what is this? Some unnecessary litigation will arise as to somebody will try and say that, no, it's only at the end of the year that the remuneration is determined, and therefore, what I've paid is drawings, etc. So there will be sort of, unnecessary litigation on this. And therefore, I think this needs to be a situation that, yes, where the remuneration is determined as a percentage of the share of profits, then on 31st March, it would suffice for deduction of TDS.
Sir, just for the Karishma, yes, we are taking up this matter in the post-budget also, 194T. Obviously, our idea is that 194T should not continue itself, number one. And even if it is to continue, we are also alternatively, because, I have given the background that they possibly may not roll back 194T. So at least 10% should be quite higher, even if it is at lower rate, because the main idea is if they want that what the partners allowable remuneration has been claimed in the firm's return, and that is actually been offered or not over here. Just to track that, then the minimal TDS rate of 2% or something could have been done.
Piyush, one suggestion. Yeah. Instead of TDS, see what they want to track is partners who are not filing their returns in spite of getting remuneration from the firm.
Correct.
So therefore, why not put it as part of AIS?
Correct.
So, rather than that, so they will get the information. And immediately, if there's a mismatch, they can immediately catch the partner. See,
Yeah.
what is happening is, unfortunately, in all these cases, TDS is being resorted to instead of, because today, I think this AISTS it captures a lot of information and, very useful for filing the return also. And well as for tracking whether the person, if there's a large mismatch, the department also can take it up for
And I
assessment or
think so,
reassessment.
if I'm not wrong, Gautam bhai, I think so even when we are filing the return of the firm, what is remuneration actually paid to a partner along with the PAN number, I think so details are going in
It's
there.
given, it's given.
In the ITR, it's already been captured. So department is aware of that particular information PAN wise, what is the remuneration
Correct,
paid, what is allowable and what is the disallowable portion. So I
correct.
believe they have a fair
So that can come into the AISTS directly. It could come in there directly, be picked up from there. And
Sir, only Grishma, I'll just take your minute from Gautam bhai. Interest, which will be obviously if I'm giving a monthly remuneration, so interest also, if I'm paying interest to the partners on the outstanding amount on a monthly basis on an average balance I'm working, so interest will be also subject to, I'm sure, on the
yes,
one.
interest will also be
There
subject
is
to
a
TDS.
clarity in that, I
Correct.
believe.
And normally what happens is, most people would rather prefer to pay interest separately rather than the drawing. Of course, there could be situation where people just take drawings, monthly drawings, and then interest is also credited at the end of the year. But, I think ideally one should pay interest at least separately so that the separate TDS is there on that.
No, even if I do not draw, for an example, I just credit it to my
Credit at
partner's
31st
capital
March, then
account
in any case it will apply.
or
But what
a
I'm saying is to simplify it, pay the TDS separately rather than just crediting it and the thing. So instead of normal drawings, you pay a separate drawing for the interest so that you deduct TDS for that, and there's no dispute as to the date of payment. That's a practical way to achieve.
I'll just one question because I had also made that question for you, Gautam bhai, and we had a different views on that on this capital gains, which was unutilized capital gain in the capital gain account scheme. What it says, if you do it section 54 or 54F, then it would be chargeable under section 45. So the tax calculation. Now, once if I go to chargeable under section 45 of that particular previous year, don't you think this would actually open? One could argue that. Tax rate because it is going to be chargeable under section 45
No,
of that
no,
particular.
Piyush, just look at section 112 as
Yes,
amended. They're
right.
saying that the amount of income tax payable on total income is reduced by the amount of such long-term capital gains, had the total income so reduced been as total income, and the amount of income tax calculated on such long-term capital gains at the rate of 20% for any transfer which takes place before 23rd July 24, and B, at the rate of 12.5% for any transfer which takes place on or after the 31st of July 24. So for the rate of tax, the date of transfer is important.
Transfer is important as far as 112 is concerned.
And while it deems it to be, income in the year of, 3 years gets over, it does not deem it to be the date of transfer. Date of transfer does not change.
So ideally it is captured in 112.
Yes.
Right. Yeah, Girish.
Now, since we are discussing about the rate under 112, the next question also pertains to the same. So, whether a position can be taken that capital gains on unlisted debentures and bond, though short-term in nature, under Section 50AA, can still be taxed at 12.5% because of 112A. 112.
Yeah, I think this is in the context of, short-term capital gains under Section 50. Whether that can be, you have the ACE builders and you had other decisions where the view was taken that for the purpose of 54 EC bonds, etc., it will still continue to carry the character of long-term capital gains if the asset was a long-term capital asset, though it is deemed to be short-term capital gains for the purpose of Section 48. Now, if you look at Section 50 AA, it does not say for the purpose of Section 48. That is one distinguishing feature, and therefore this is on a slightly weaker ground is the way I would look at it. And there could be some doubt as to, I mean, one may try and argue that yes, this is only but this is, I think, a significant difference. And therefore, because of the fact that it does not say for the purpose of Section 48, 48 is the computation provision, and that which means that instead of the cost being deducted, you will reduce the WDV, etc. That was 50 this. Now 50 AA deems it to be short-term capital gains, and I think there possibly you're on a much weaker footing, maybe difficult to, because I think the intention is, and let's look at the intention. What is this? Through a specified debt fund, what are you doing? You have the debt fund which is investing in interest-bearing debentures. If you had invested directly, that would be taxable as interest. Now, because of you're trying to convert that capital gain into a long-term capital gain eligible for a concessional rate of tax by rather the mutual fund has structured it in such a manner, and therefore you're seeking to get a benefit of paying tax at a lower rate on amount which should rightly have been taxed as dividend as interest. So therefore, there is this arbitrage opportunity which is there because of that, and which is what they have rightly plugged that loophole, I think. So therefore, rightfully, I think, in substance, what you are earning is interest which is earned by that mutual fund, and therefore tax should be paid at the short-term capital gains tax rate. In fact, even if they're provided that this is taxable as interest, even earlier, see, you have that old decision of Lomax versus Peter Dixon, which Supreme Court has thereafter affirmed, etc. Followed. So where they said, this was a very old decision of 12 ITR 1, where they said that look at is premium in the nature of interest. Because if you structure an instrument whereby you get premium and you get a lower interest, etc., is that premium in the nature of interest? And they gave later, how do you determine that? If the premium is in lieu of interest, then yes, it is interest income, is the view that they've taken. And here, this provision is, in a sense, a similar sort of provision to ensure that you pay tax at your normal rates, though it is taxed as short-term capital gain and not as interest income. That's the way I would.
Heading towards the next question is whether buyback tax will be applicable even where there is no accumulated profits with the company.
Yeah, I say I did refer to it in my presentation. That would be applicable. Irrespective of that, it would be taxed as dividend.
Sure.
Because artificial deeming fiction, really.
Okay. And other is also related to buyback only. So in case if the buyback happens under merger scheme, will still the buyback tax will be applicable?
So if it is not a buyback under Section 68 of the Companies Act, then the buyback provisions will not apply. That's the so therefore you have to really look at it. Is it under Section 68 of the Companies Act? Because now the buyback provisions apply only in the situation of 68 of the Companies Act 2013.
Now there is the offer for sale amendment is retrospective. So what will be the impact on the assessee currently because of this amendment?
So there could be a demand where they are up in appeal. Obviously, those appeals will now be decided against the SSEs in those cases, where they have they've claimed exemption and that matter was accepted in assessment. There may be a reassessment today which could be resorted to. So that will be the implication because of the retrospective amendment. And because this is this is from, effectively from any public issue made, IPO made on or after 1st January 2018, that is assessment year 18-19 onwards. But most of the IPOs, I mean, that would have been for only that 2.5 month period. But thereafter, most of the IPOs would be from assessment year 19-20 onwards. Therefore, they may be still covered by the reassessment provisions.
The reassessment on the basis of retrospective amendment has been always a challenge. No? It should not be generally resorted to based on retrospective amendment if the assessment has been done regularly.
So, no, Piyush, the position is what happens is that what does a retrospective amendment do? That is how the law has always stood. Is the now the question here is that if that was the position as the law always stood, then firstly, can one resort to 154? Is it a mistake apparent from the record now? Then therefore, even 154 could be resorted to is the way perhaps is, I mean, it's debatable, of course, but, so it's like a judgment of the Supreme Court is something which hits you, it could be under 154, like your 36(1)(5)(a), your deduction for employees' provident fund, the view which has been there. Because tomorrow, if there is a decision on Supreme Court, it could be, now, of course, in a situation where there is a retrospective amendment, whether that reassessment can be resorted to or not is something which may be a matter of debate. Yeah.
I think so. All these people who are fighting in appeals, they should go for BSV now.
Yeah, possibly. This will be something which would help them.
It will be cheaper.
Absolutely. There will be no penalty or interest. So that will be the thing. They'll get away with just the tax.
No penalty, though still they will succeed because the law was not clear. That the amendment itself shows.
Correct.
But interest is definitely.
And they will save the cost of litigation also.
Yeah. And I was just reading in newspapers, Gautam bhai, that's a huge benefit. To
these are huge amounts involved, no? Because when promoters are
they
selling,
came across during survey in certain groups also. So that's why. Yeah. Yeah, Karishma.
So the next question also is pertaining to Vivad se Vishwas scheme only. So whether such cases will be covered under Vivad se Vishwas 2024 scheme?
No, that's not covered. Correct. The MSV 2020 also there was an exclusion. Similarly, there's an exclusion for 2024 also.
Other question is related to such cases, whether declaration of undisclosed income in the return of income and payment of 60% tax thereon without any interest and penalty tantamounts to inbuilt settlement of such cases.
No, you are already paying 60% in my view, so it's nothing like inbuilt settlement. Earlier also there was an immunity from penalty available under the earlier such provisions also. If you would have given a statement and declared that income during the course of statement recorded under 132, and you would have actually included in your return which is filed pursuant to 153A notice, and taxes have been paid, that the immunity was already available in the penalty proceedings also. So I believe it remains similar. So there is nothing as such that there is immunity because you are already paid 30 plus 30, it's 60% anyway. So I think so it cannot be considered to be settlement of settlement scheme sort of, in my view.
Now we have received 2 or 3 questions with same relating to TDS on remuneration. So when it will be applicable, whether it will be applicable from current year or from the next year?
No, it will apply from 1st April 2025. It will not apply for the current year because this amendment is a procedural amendment, is the way I would look at it, because TDS is a procedure. And therefore, this procedure cannot apply for the past. Obviously, if you say from assessment year 25-26, that's not. So this will be, being a procedural amendment, it will apply for any payments on or after 1st April 25.
With this, we have covered almost all questions. And thank you, our speakers, for the insightful contribution to today's discussion on union budget. Your expertise has provided us a deep understanding of the direct tax proposals and have also thrown light on the complexities surrounding the proposals. So this was a truly knowledgeable session. Thank you once again.
Thank you.
Thank you, Gautam bhai.
Thank you.
Gautam bhai,
Thank you.
just 50B, that 3 years, 2 years, we are including in our post budget. I thought when you were making your presentation that the amendment of 3 years to 2 years for long-term
Correct.
capital
Correct.
has
That
not been
remains.
done in 50B. We have already mentioned, and I believe it will, it should be covered in the act because it seems to be an error or
Yeah, they missed out, I think, because it is in
yeah,
50B and not in the
yeah.
240B.
And this capital loss and dividend also, which you mentioned, that my loss will be at 12.5%. I could only adjust
Correct.
against
Correct. And the
12.5%.
dividend is
Whereas
at
dividend I
39%.
would be paying at
39%.
30% or maybe whatever slab rate. So at least to a limited that extent, if an adjustment can be permissible in that year itself.
Correct. Exactly. You tax the net amount as a dividend. That's the better thing.
That's already we have included in our post budget memorandum. So
Correct.
these two things are already going. Apart from 194T, which you have mentioned, that is also going. So we hope better sense will prevail. Let's see.
Yeah, let's hope and pray that there's some
Yes. Thank you, sir.
decent
Thank you,
development.
Gautam bhai. Thank you very
Thank
much.
you.
Thank
Thank
you,
you.
Karishma.
Bye.
Thank you. Bye.
Bye.
Stop the recording, tag team.
Recording stopped.